All right, welcome everybody. This is the April Startup Tank with Forward.vc. We have two investors on the line and two startup founders that will be pitching today. Russell and Karen, do you guys want to say a few quick words?
Happy to go first. Hi, Russell Sproul, founder and managing partner of Verta Ventures, which is a early stage climate tech fund focused on equity-like business models that are digitizing and decarbonizing energy, mobility, the built environment, and sustainable agriculture. And we're really excited to be here. Thanks for having us.
Hi everyone, I'm just gonna go on video really quick. I'm here eating my breakfast,
Yeah,
getting my
it's
day
really
started.
early your time.
Yeah, it's really early. My name is Karen Sheffield. I'm the founder and managing partner of Pachamama Ventures. We're an early stage VC firm based in San Francisco, and we invest in climate tech companies across the entire tech stack, if you will, mostly based in the US, um, operating in the US or moving to the US. So happy to be here.
Okay, so I think all the founders are aware of the format that we're going to go. It's going to be a 5-minute strictly timed pitch for each founder. At the 4-minute mark, I'm going to interrupt you once to let you know that there's only going to be 1 minute left, and the pitch is going to be followed by 10-minute Q&A with the investors. Okay, so I'm going to go with the order on my screen. So Kirill, you get to go first.
Yeah, thank you. Thank you very much. So I'll share my screen.
Let me enable that
Yeah.
real quick, and then I'll start the timer. Okay, you should be able to
Yeah.
share it now.
Yeah, I can.
Okay.
Yeah, it's a pleasure to be here. My name is Kirill. I'm the CEO and the co-founder of Smart Agri Labs, and we are building AI-driven solutions to make agriculture more resilient. We have actually two products now. The first one is a data-driven solution, which is AI-driven seed selector that delivers 5% yield improvement based on the previous season data. And we achieved since launch 100% monthly revenue growth. And the second part, it's we have more hype around large language models. So it's basically our own model, which placed third in the independent trials, just behind Opus and ChatGPT-4. But we have a significant benefit because we actually provide the sources for each answer. So it's a way how to reduce the hallucinations and bad responses. But I want to focus today on the seed recommendations and to share why we believe it's a really important part and why we basically focused on this, because the current status quo is based on the fact that current recommendations are subjective. They made by people. They're usually based on local trials, and usually it's basically something around average, yeah, in terms of potential. And even based on our 5% yield improvement, we can recuperate $17 billion in lost profit for the US corn and soybean market. And the main reason why current seed recommendations are not performing well, it's basically weather variability. And the current approach is ignoring this factor. But there are other reasons as well that you can see on the screen. And even Bill Gates said that it's possible to advise farmers on the best seeds for their allocations based on AI. We're doing exactly that, and so we build these proprietary models that create field-by-field recommendations. Even 5% yield improvement creates actually significant profit. And for some of our users last year, it was the only profit they had. Regarding the climate connection, so obviously we reduce land conversion, and we also help to transition to no-till and other sustainable practices. Overall, in the US, the market is $1.5 billion based on the price of $8 per acre, and globally it's $10 billion based on the basic plan, which currently is at $3 per acre. From the team perspective, we're a team of actually 5 people, 2 co-founders. So my personal experience is mainly connected with product, project management, financial consulting, and Phil has more than 35 years of experience in seed evaluation and agronomy. Our vision is to build this unbiased AI-driven crop inputs management platform, which will cover not only data creation, but also a risk management part. We started with corn and soybeans. We're going to add other crops and going to expand to other geographies as well. But in the future, it will cover also not only seeds, but also biologicals, fertilizers, and other products. And our goal is to reach 10% of the US market share in 5 years. And we're raising this pre-seed round. It's $1 million for 2 years in order to onboard customers with 300,000 acres by the end of 2025. Yeah, this is a short presentation, and you can see our email and calendar link if you want to connect with us. Thank you.
Wow, you had a minute left.
Yeah, I decided to spend this on Q&A.
Okay, well, Russell, Karen, your turn to fire off questions.
Kirill, thanks for the presentation. Walk me through how you break through the agriculture's industry's difficulty in adopting digital technologies. Historically, it's notoriously difficult for farmers in the agriculture industry to adopt digital solutions. Really, no digital solution has broken through, and it's incredibly difficult. So how do you think you will break through that?
Yeah, thank you. That's a great question. It's actually the main problem here, yeah, for every player, yeah, on the market. So the first actually approach that we took is it's a community that we're building around the platform. So at first, it was 2 years ago, we created a smart, I would say, approach of involving farmers into the network. So we created a farmer advisory board, and these people actually test our solution. They're doing trials, field trials, and they create some sort of feedback loop back to our system. So it's a way to improve the product. The main go-to-market strategy, I think is not obviously direct to farmer. It would be too costly and would create significant I would say significant frictions. Maybe it will be a successful first couple of years, but in the long run, we believe that partnerships and distribution channels are the best approach. And obviously, we partner with some agri-retail players, with crop consultants. In this way, basically enhance their current offering. We provide the tools that could elevate the current productivity, and in this way they can spend more time with their growers and spend less time on data collection, analysis, and so on. So again, the main go-to-market is to partner with such players who already have these relationships and trust with the growers. Yeah, so this is the answer.
Okay. My questions are around the revenue model. I believe you're pre-revenues, right? Is that right?
Yeah, for the seed selection, we have since launch we had revenues each month, and the revenue growth is 100% monthly. But it's early based on the it's still in the early stage, I would say.
Yeah. So what is the revenue model like? How do you charge? What is the fee types and all of that stuff?
Yeah. So currently, if we go directly to growers, we still have this channel. It's $3 per acre. And there is an option. There is a premium plan with additional features. It's $80 per acre. And for example, for each of these plans, we created basically on average $50 per acre profit. So there is obvious up to 1,600% return on investment. But for enterprise channels, we usually build and we have some pilots started. So it's a white label solution. So there is a part connected with the software development, data collection, and so on. So it's kind of fixed part, and the rest will be based or on the number of units, so bags of the seeds sold, or number of acres as well. So, but the price is obviously lower than this $3 per acre, which is more like a retail channel for us.
Okay. And I know we have to move along onto different pitches, but I think that would be good to highlight if I can give feedback. It's like the revenue model. If you have revenues, I would love to see that. If you have revenues, definitely show that. And financials, a financial slide. I also didn't see a slide or you talking about competition. That definitely needs to be something that you would include there, because investors are going to ask who your competitors are, and you definitely have competitors. The
Mhm.
answer is never no. I don't have competitors. Um, and then what else? I would say the 5% improvement in yield. Maybe it's worth unpacking what that means, at least an order
Mhm.
of magnitude in anything else, right? Because
Yeah.
VC investors are looking for an order of magnitude better than business as usual. In-
Yeah.
Cost savings, 5%. I mean, I know you've mentioned it throughout the deck, and at some point you said 5% improvement in yield. That's a lot for profits, but how much more? Like, right,
Mhm.
like put some numbers around that.
Mhm.
But that's where I would leave so that we can keep moving.
Yeah.
Great
Thank you.
presentation, otherwise. Thank you.
Thank you for the feedback.
Echo, how much more time do we have? Just time check on.
You can ask another question if you want.
Okay, great. Kirill, can you talk a little bit more about the channels that and how you plan to work with your channel partners? You mentioned how critical they are in terms of accessing, hundreds and thousands of end customers. Are you going to license this? Are you going to white label it with them? How much revenue share are you going to give them so that, you really incentivize them to push your product?
Yeah, so that's a good question. So for the white label part, it's mainly relevant if we work with agri-tail and seed companies. In this case, we can train our models on their data, and basically we can provide a discount of let's say 30%. But if we resell the solution through the distribution network, we have, for example, some partnerships already with the crop consultants, with the 25 farmers in their networks. And in this case, again, the sales commission could be around also 25-30%. And in this case, but some of them, they're really interested to buy this as a pass-through product and to improve their current portfolio. Yeah, in this case, it will be a different price structure, which is negotiable for each player depending on their volume and number of farmers in their networks.
Great,
Okay.
thank you.
Yeah, thank you.
Well, going clockwise, I guess on my screen. Albert, you're next.
Sure, let me share my screen.
Sure.
Are you able to see my screen?
Yep. Go ahead, please.
Everyone, so I'm Albert. We're building Clipp, and we're building software for food ingredient suppliers that are built by industry insiders. And we're here to replace QuickBooks, Excel, pen and paper, phone, and even fax machines. So, this matters because, as everyone here in the room knows, a ton of food gets wasted. Almost 30 to 50% of food produced ends up back in the landfill. And a lot of that is because the companies that are distributing these food ingredients, a lot of them still look like this today. So on the left-hand side is what a typical office looks like. You have the product cards on the wall, outstanding invoices on the corkboard over there. You can see their little stamp here for stamping invoices if they're paid. And the prices change a lot as well. So they have these pricing cards here as well. Once the order has come in, it makes its way into the warehouse in the middle there. That's the warehouse management system for a distribution center that does $100 million in sales. And then on the right-hand side, this invoice gets passed on to the restaurant, who then pays by cash and check and brings that back to the warehouse for clerks to reconcile. And so we're able to get these pictures and insights because my co-founder, Jason, used to own one of the largest garlic and ginger importers in the Northeast. They exited that business in 2007, and he now owns 7 restaurants on both the East and the West Coast. So he has an inside view with a lot of these suppliers, and they've been able to work with us to help build this app. And then myself, I led various roles in HR, finance, and ops at Workrise and Uber, and I did a couple of years in investment banking. So through these conversations we've had with suppliers, a lot of them are finally considering the change, even though a lot of this technology has been around for over a decade. Main reasons are rising costs. a lot of the suppliers are absorbing the cost because they know if they offload all of that, restaurants won't be able to bring customers in. So eating costs on top of 0 to 3% margins is pretty difficult. Labor shortage show less people doing more work. The third is success stories from the restaurants. So because a lot of the restaurants adopted tech and did survive during COVID, like my co-founders' restaurants, they now have a case study and believe in tech. And a lot of these owners are pretty old. They're between 40 to 60, so more in the 60-year-old range. And they're looking to transition the business to their kids or exit to a private equity fund. And those individuals, they want to deal with software and not with this on an everyday basis. So we've created a tool to digitize manual workflows and 100x their efficiency. I know the 100x can be hard to believe, but when you're dealing with fax and phone calls, re-entering those orders and using a piece of paper to manage the ordering process, it's pretty easily attainable. So we digitize the order management, we help digitize the payments, and then thirdly, we help automate the sales to increase the inventory turnover. And this is particularly important because these goods are perishable. So if the shelf life is fluctuating and changing all the time, you want to be able to push it out extremely quickly. So, there's a couple of competitors in the space. We consider our largest competitors in the top left, which is the simplest to use, but also the least tailored to its food suppliers. That group of fax, phone, email, and text, Excel and QuickBooks, have about 60 to 70% market share. So they've been around for a while. And then in the bottom right, in the gray circle, this is a group of legacy ERPs that are really complicated,
1 minute
require full
left.
and that's a very small slice of the market. And then there's folks in the middle that have split their time between restaurants and food distributors. But through our conversations, suppliers do want to make more money, but they want something almost as simple as what they have already. So that's what we've optimized for. And with that positioning, we've been able to generate a pipeline of 10 suppliers. That's around 1 million in ARR by the end of next year. And so, these food suppliers, there's actually a lot of them. Most of them are smaller suppliers, and they supply half of all ingredients that are sold. And Clipp's revenue model is we take 3% of goods sold and also charge on the digital payments as well. This is competitive to them paying physical labor, 1 to 6%, and a small base salary. So there's a lot going on here.
Time's up.
Okay. Have to stop there, unfortunately.
Yeah,
But
sorry to cut you off.
yeah.
Albert, what are you looking for in terms of capital, and what are you looking to do with it? You're welcome.
So we're looking to raise 1.5 million to extend our runway for the next 2 years. The supplier pipeline we've had, we started with 3 suppliers that we designed our app with, and we got a larger than expected pipeline to onboard that we can't onboard until next year. So we want to onboard them and accelerate that through some key hires.
And it looks like your suppliers are averaging at scale, looks like the customers are going to ultimately be about 100K per customer. Is that accurate?
That's accurate.
Talk to me about the 3%. How have you validated that a significant portion of the market will be willing to accept the 3% kind of take rate?
Yeah, we've talked to over 50 distributors. And so because suppliers' core business is inventory management, and they're paying physical staff a base salary of 20 to 40K, plus a commission of 1 to 6% to do this job manually, a lot of suppliers are willing to pay the 3%. The other important piece is currently suppliers have a roster of salespeople that own their book of business. So if somebody from US Foods goes to Cisco, US Foods loses most of that book. But we're now returning the power back to the owners themselves, and there's a ton of value in that as well.
It's a great point, but it also creates a challenge. Like, how do you ultimately get the users to really adopt this across all the processes they need to adopt this? It seems like, you know, it seems like it's to a certain extent, it's going to be top down, right? You're going to sell to the owner of the business or the, you know, what have you, and then they're gonna force their teams to use it.
Absolutely. Yeah, that's correct.
And how does the end user really appreciate the value of it? I understand how the business owner would, but how would the end user appreciate the value of it? Are they gonna get paid more? Are they gonna be able to do more with less time? Just trying to understand like what's in it for them to adopt this and use this on a day-to-day, hour-to-hour basis.
Yeah, there's a couple of pieces to that. So one, people in the industry work really, really hard and long hours. So it's hard for them to learn something like completely new. How we're different from everybody on the market is we're not asking people to change the way they do things. They can keep the existing setup and operations, but here's a tool to do that much quicker. So we spend more time making our apps simple relative to QuickBooks and other apps on the market rather than keeping it complicated. So that's the first piece. The second piece is because there's a lot of people leaving the industry, you're finding that the office clerk is now having to do a lot of sales work. So there's less people trying to manage more accounts. And so this makes their job easier because they can manage now 2 to 3 times more accounts with the same amount of people. So to flip that, you can reduce your physical labor force by 30 to 60% while managing the same book.
Karen, do you have any questions?
Yeah, it's a great presentation. Thank you, Albert.
Yeah.
So can you give me a sense of who are paying revenue, your revenue paying customers right now? Who is paying currently the 3%? Like, just gonna keep asking, getting to the part of like the validation of the 3%, which was a good question from Russell, and I had the same.
Yeah, so we launched with a smaller supplier at the end of last year. Depending on how large their business is, we charge a blend, either a subscription fee or that X%. And the X% kicks in after they've onboarded half their restaurants. So currently with the pilot, the revenue is pretty minimal. It's a couple $100 so far. But with our next supplier, they do $10 million in gross sales volume, and we can charge those suppliers 3%.
Okay. And I think that would be great to highlight, not obviously not the current revenue necessarily, but the LOIs or any big clients that you have coming up in the pipeline. So I'm sure you do, right?
Yeah, sounds good. We do have a couple logos here, but a lot of food suppliers, they don't even have websites. Uh,
Right.
so in
Yeah.
some ways, like it is proprietary, so we try to keep the name with ourselves because only my co-founder has access to those companies.
Got it. Okay.
Albert, can you
Great.
talk a little bit, can you go back to that competitive slide that you were just on and talk a little bit more about the group in the middle? That's probably the one that would for me be the biggest kind of competitor. Which of these are actually selling to food suppliers? I know Toast is more of a restaurant solution. Maybe they have an offering for food suppliers too. Choco, I think, is a little more for food suppliers, but talk to me about that middle group and where they are in terms of direct competition to you.
Yeah, we see ourselves as indirect competition to them. So Karen, I think you invested in Journey Foods. You can think of us as Journey Foods for like the distribution houses. So I can speak to each of those very quickly. So for Pepper, they provide a white label Shopify for suppliers. But as a restaurant owner, you do have to download an app for each individual supplier. That creates a pretty unseamless experience for the restaurant side and actually adds to the workload. So it's actually hindering their growth. And my co-founder like didn't want to use Pepper initially. As for Choco, in their US expansion, I know they raised a lot of capital, but it seems like they're using MBA undergrads or people outside the industry, and they're acquiring clients on the restaurant side. I think over time, you're going to see really high CAC because restaurants have a high churn rate. We focus on the food suppliers because each supplier delivers to 100 to 200 restaurants, and their core business is inventory management. For restaurants, inventory management is number 4 on the priority list. So have some question marks there. Reiki is a marketplace that I heard is in the middle of pivoting their business now. And then Notch focus more on just the invoicing piece. So they're not an all-in-one solution. They just focus strictly on like payables collection.
And this super helpful for Clipp. The customer set for your suppliers, are they primarily focused on retail and restaurants?
Yeah, so they're focused on restaurants, hospitals, and schools.
Okay. And do you plan to integrate with I guess the Toasts of the world or whoever's on the restaurant side to make that really seamless? Or how do you think about integrating with their customers' systems?
Yeah, that's a great question. We're in contact with a couple of POS companies. It's further down in our roadmap, but initially the order tool, the order management system I showed in the deck, that's the first step in getting into the suppliers because all of the data is offline. We need to collect that first. Once we have that data, we can then get into AI. So you might be wondering why I never mentioned AI in the deck. It's because the first step needs to be able to digitize the data first. Once we have that data, we have some AI tools, we can then expand upstream across the supply chain and also downstream as well and connect to POS systems. So the vision is like to create a seamless digital highway from the farm all the way to the restaurant so that, when you're walking into the store and you're, buying a burger or whatnot, the farmer already has that information even before then. It's the same technology I saw Uber implement where, by the time you're ordering a ride, they already know when and what price to maximize your propensity to spend. And I want to take that and apply it to the food ingredient industry.
Got it. So you're starting with their customers, and then eventually you'll move to their suppliers, the farmers, to digitize that side as well.
Yeah, we're focusing on the distribution centers.
Yep. And does your revenue model change at all, or do you add revenue streams as you expand the offering here?
Yes, we do. So we have the digital payments. This is illustrative based on 5% market share and 20% of transactions that are digital. This is based on today. We do expect that as a percentage of overall payments to grow because the benefits are obvious. You're not losing cash. You get to collect your cash upfront at time of order received as opposed to waiting until you get the cash in check. So we've learned that suppliers are willing to pay between 2 and 7% margin for being able to collect their cash earlier because their cost of capital is high. If they're late on getting the cash and there's decreases in ingredient prices, they're not able to take full advantage of that. And it's also like a money lossing situation as well. So we have ability to expand on that take rate as we build out our payments platform and provide additional AI tools down the road.
Is that digital payments is the way to think about that? Are you essentially kind of floating the money and bridging the gap between the payment terms that your customers are currently kind of providing?
Correct.
Got it. So there's a not so insignificant cost for you to obviously do that with either debt or equity internally, right?
Right.
Okay, we do need to move along. It sounds like there is interest to continue the conversation. John, you're next.
Thank you, everyone.
Thanks, Albert.
Thank you very much. Just please confirm if you can see the screen and let me know when
You're
we're
good.
ready to start. I'm going to start my own timer here to
Okay.
keep track of time. Okay, good morning, everybody. My name is John Restrepo. I represent NOC Energy. This is no carbon energy. What we do is electrify the production of industrial heat without producing any CO2 emissions. The problem or the insight that we had to create this company is that about half of all the energy that is being used in the world, goes to one application and only, that is creating heat for industrial processes. Almost every company has, or every manufacturing company has the requirement for heating up something, being a furnace, an oven, a boiler, a dryer, or what have you. About 70% of all the fossil fuels that we extract from the crust of the earth goes to industrial heat. Therefore, if we do not solve the problem of heating things up in industry, we will never get to net zero. This is a huge market opportunity, about $10 trillion as valued by McKinsey. So what we did was create a solution for this, and that is we can take firm electricity from the grid or intermittent electricity from renewables. We put this into our system, and we create and store heat at very high temperatures, about 1500 or 20 Celsius or 2800 Fahrenheit. We then deliver this energy in the form of heat to industries. We also have the ability to recycle process waste heat from industries and thereby increasing energy efficiency. Our focus is mainly on high energy intensive industries, and specifically industries that require heat at very high temperatures at about 1500 Celsius, as I mentioned before. And those are mainly oil and gas, mining, cement, and all the value chain for building. And that is, of course, cement and steel, but also glass and ceramics and so forth. Our technology is being patented. We are working inspired from 3 different and robust technologies that already exist in the market. One is what we call a packed bed heat exchanger. Is widely used in chemical industry, but also in nuclear industry. One of our co-founders actually come from nuclear industry. And that is a number of spheres of special materials inside of a high pressure vessel. The second part of the technology are the spheres themselves. They serve 2 purposes. They can store energy in the form of heat, and they also serve as the heat transfer elements, providing the surface area where the heat transfer occurs. And then the third part of the technology is the heating source. Currently, with electricity and resistors, you can only get to about 1,000 degrees. But if you need to increase the temperature to 1500 or beyond, then you need advanced physics, and that's what we do. We use electromagnetic induction to heat up the spheres. That means that we are competitive against natural gas and hydrogen in most geographies. We can scale the technology to gigawatt industries. It's a platform that is very flexible because it can be integrated seamlessly with existing infrastructure, uses proven technology that is being used in industry for many, many years, and then is designed to work with a high temperature, ultra high temperature to reach these hard to abate industries. We have already started the commercial rollout. We passed the lab scale. We're building a 70 kilowatt prototype that is going to be installed in our customers in the next 3 weeks. And then we have a pipeline of customers that are mines, lithium mines in Chile, iron ore mines in Brazil, oil and gas companies in Colombia, cement company in France, and so forth. The team is very seasoned and very experienced in developing large industry and infrastructure projects at international level. We have worked in Europe and the US, Africa, and Latin America for many years. What we're looking for is to raise 2 million in seeds in 2024. That is to complete the hiring of the team and then to accelerate the commercial rollout. Yeah, and I'll be very happy to answer any questions that you might have.
Thanks, John. Can you talk a little bit about the risks as you scale up? Are there key technical hurdles that you have to overcome as you scale up, or is it more about kind of just making sure that your costs can be low enough to be competitive and outprice your competition?
Right. Well, this is more of because we are relying on robust and established technologies, and the innovative component of our technology is in the integration of these different technologies. The risk is relatively low. This is more of an engineering project than a scientific endeavor. Of course, there are difficulties. We have a de-risking strategy, and that is making strategic alliances with partners. We're partnering with a induction furnace manufacturing in Canada. We're partnering with McKinsey for market development. We're partnering with Schneider Electric for all the electrical and power components. And this strategy is to, as you mentioned, to reduce risk, but also to ensure that we can have an expedite and fast market rollout. We don't have to develop everything from the ground ourselves. We do it through strategic partners.
Great, thanks. And are all of those locked in terms of those partnerships?
Can you repeat that? Sorry, didn't
Did
get
you,
it.
you mentioned a bunch of names in terms of partnerships. Have you secured all of those?
Yes, we have signed MOUs or LOIs with those partners. Yeah.
Karen,
As
any-
well with customers, the engineering, sorry, the rollout, the commercial rollout that we're doing currently with the industries that I have mentioned are already being secured by means of contracts with them.
Good, thanks.
Hey, John, just great presentation. And on the expenses side, can you give a little bit more of a feel for the 1 million in 2024? I see the breakdown in R&D and management and sales, but how much of that is all really CapEx? I mean, I'm assuming most of R&D is CapEx, but just like a breakdown, a further breakdown.
Yeah, actually no. Most of it is for salaries for the team, just to be able to do a rollout, a quick rollout. So we're able to do all the detailed engineering for the projects that we have at hand. So very little is CapEx, because most of the or all of the projects that I have mentioned are pilot projects paid for by the customers.
Okay. And what degree of confidence do you have in this, like the sales projections to $500 million in 2030? Like, how do you go from 2027 to 2030 to $500 million? Is that like, are you having some key customers in the pipeline that are like making the brand of it, like an 80-20, or how?
Yeah, all the pilot projects that we are negotiating at the moment are with customers that have the intention or the requirement by their shareholders or their governments to decarbonize their respective industries. So, for instance, one of the pilot projects that we're negotiating is a 600 kilowatts for a lithium mine in Chile that represents only 15% of all the energy requirements for one of the processes, which is the drying of the lithium carbonates. But when we take into consideration that they have a roadmap for decarbonizing the whole operation, then that project is going to be significantly higher. And that is just one example of the way we have chosen the pilot projects that we are developing at the moment. So they all have the possibility to scale to full-fledged decarbonization projects within their respective industries. So we have a relatively high degree of confidence, but of course these are market and financial projections that might change.
Mm-hmm. Yeah, and then just last questions on the team. You all seem to have several years of experience in your fields, but is any of you a prior founder, or like have you raised capital before?
Yes, actually, myself, I have managed, but from the other side, I have managed two corporate venture capital funds in the past, investing in energy and infrastructure. Giovanni is been a founder himself. He's got two companies that he's found in materials, in advanced materials and robotics. And Nicholas is also a founder of a company that is doing crypto mining with the energy in the flares of gas and oil fields. So we all have, or at least the three of us have previous experience with startups and funding. And Carlos used to work for Rondo. Rondo is one of the competing technologies in this field. He was one of the first employees. He was also a partner in Rondo, and then he quit last year and sold his shares. So the four of us have experience with funding and creating companies.
Yeah, and then for this specific company, when did you start it, and have you raised capital before, or is this the first time you're raising institutional capital?
We've started about a year ago, creating the first prototypes and minimum viable products. We are just starting this round to raise this 2 million in seed, and we have so far raised very little. We raised 25,000 from the mine in Chile, and then we're doing due diligence for some angel investors for this 2 million. So we're not closed those rounds yet, or this round is not closed yet, but we are very advanced with the due diligence with angels for this round.
That's good. Thank you.
John, can you talk a little bit about the kind of the financials and how you get to the 530, I think, million it was? You had 81 projects, I think it was, on that slide. I'm curious, yeah, that slide. How many customers, is that 81 customers, or is that 81 projects across 5 customers, 10 customers? How should I think about how many customers it's going to require to get to 81 projects?
It will be about a customer per project, with some exceptions. Of course, we're talking to some cement companies, for instance, and one of the pilot projects that we will be doing this year is with a technology provider in France. And some of those cement companies have multiple plants, and then there will be multiple projects as well. But I think it's fair to say that it is about the customer per project with exceptions.
Super helpful. Can you go a little bit deeper into your IP strategy and kind of where you are today and how much more you need to do to kind of protect the core IP around this?
Yeah, sure. We did a freedom to operate study and a patentability study that resulted positive. That means that it was found inventive value in what we're doing. We filed the provisional patent application in the US in last November, and at the moment we are preparing a PCT application, and after that we will be preparing the national phases. We have already identified the key markets where we want to protect our IP, and that's going to be the US, Europe, Australia, South Africa, and then a couple of countries in Latin America. Chile is of interest to us, Brazil is of interest to us, and Mexico, basically. So we already have outlined the roadmap for the national phases for this PCT patent.
Great, thank you.
Okay, I want to move this along. Shingi, you're last but not least.
Perfect. All right. I will share my screen as well. Just one
Thank
moment.
Thank you for the great feedback.
All right, there we go. Hello, everybody. My name is Shingai Samudzi. I'm the CEO and founder of Asoba, and we've developed a smart grid that will unlock economic development across Africa. So first and foremost, Asoba started as a 30-year passion in economic development. I'm the son of two immigrants from Zimbabwe living in the United States. And the time I was born was a time in which there was a ton of opportunity for Zimbabwe. And we were thinking about all the different ways that we could contribute to making it an incredible place, to continue to be the breadbasket of Africa. But the foundational problem with Zimbabwe and with all of post-colonial Africa is the lack of electricity availability. In fact, access to electricity is the foundation to economic growth. There's almost a one-to-one relationship between access or availability of electricity and GDP per capita, and we can see where Africa falls on that line. The truth is that development dies without adequate power, right? And we see that nearly 80% of businesses across Africa deal with daily power outages. Looking at South Africa, the continent's most developed market, we saw in 2022 over 200 days of load shedding and 7% loss of GDP. That's $30 billion of economic value lost due to load shedding and due to lack of available power. Now, the flip side is the current trend. We're seeing exponential growth of utility scale solar across the continent, but really heavily concentrated in places like South Africa. There's a lot of opportunity for privatization. There's a lot of deregulation. There's a lot of really good opportunity for all this massive amounts of new generation from solar to be able to meet this massive gap in supply. However, there are still issues with regards to matching the new supply with the demand, right? So we no longer really have a supply issue on the continent. In fact, we have a distribution issue. In other words, all this massive amounts of new solar, I mean, over 7-8 gigawatts over the last 2 years alone that have been added to the grid. But a lot of that is islanded. A lot of that is not productive. A lot of that's not making any money because it's not properly interconnected and because there are not proper tools for ensuring that the electrons from those sources of generation actually make it all the way to people that need it. And so that's what we are doing, is that we're creating an AI-driven smart grid operator to make dispatch decisions on behalf of the thousands of meters that are tied to on-site solar generation across the continent. So a massive use case in terms of the way that we operate, or the way that we are looking to operate for larger national utilities, with Eskom and with residential wheeling, where we have a proposed pilot on the board with them for a demand response program. And their goal is to reduce the amount of waste that's resulted from wheeling power or sending power to customers that already have solar on their roofs. And so right now, what happens is Eskom just sends them power, they don't need it, and so it gets lost. With our system, we can help them find ways of shifting the load to where they need it, to the extent that there's an economic opportunity of about $250 million for Eskom. And from our revenue model, that's an $80 million opportunity for Asoba. Now, the way that it works is that we forecast supply and demand and pricing for every single meter that's connected to our system. We aggregate the available solar power that's generated by the users. And then based on the demand that we see within the system of connected users, we then send the electrons to the right place at the right time at the best price. And again, we have further use cases currently in place in terms of pilots across the Northern and Eastern Cape in South Africa. We also have pilots in Mozambique and Mali, as well as in Ghana. Our business model is an at-risk model of energy trading. We tried a more SaaS-based approach. And what we found was that this at-risk model is revenue model in which we don't actually incur any software licensing fees or anything like that. We give the product to our customers for free. What we found is that because our product generates a massive amount of net new revenue, we are able to essentially do the billing and collections, collect that revenue directly ourselves, and then take a 30 to 40% cut and give the rest back to the customer. We found that that model is much more effective at addressing the non-payment issues that happen across Africa, particularly with national utility companies. And again, our product is central to the entire value chain, from developers to smart meter manufacturers to the actual producers of power. So we see ourselves as sort of the critical piece of this new value chain. And again, from a competition perspective, we are currently the only company that actually provides actual virtual power plant, actual AI-based aggregated wheeling. Everybody else either does it manually or doesn't do it at all. And our competition are essentially substitute goods. From a team perspective, we have the right team, full of energy experts that are based in Africa. What we have found is that these types of technologies are not novel in the European context, but the business model and the market in Africa is a completely different ballgame. And that gives us an advantage being home players and Africans ourselves.
Time's up.
Cool. Open to questions.
Can you walk me through a little bit about your fundraising plans over the coming years?
Yeah, sure. Yeah, we're raising 1.5 million in total pre-seed. We're taking a blended finance approach. So 500K of equity, which we're about to close in about the next couple of weeks. We also have a pipeline of grants and then another 500K in debt. Now, 500K in debt, use of funds for that is primarily going to be for the smart meter infrastructure. We need smart meters to be able to acquire the data to be able to do our work.
And would you say that the utilities are your primary customer in terms of your sales process and kind of getting in the door?
I would actually say that municipalities are our primary customer, in part because municipalities tend to act as master meter type of arrangements where they're a master meter interfacing with the national utility, and then they themselves have sub meters of their own customers. So what we found is that in countries like South Africa, where there's a massive TAM, particularly on the residential side, it's actually not Eskom where the big money is, even though there's an $80 million opportunity with them. The bulk of the opportunity is actually in the billions, and it's actually in the municipalities doing this residential wheeling.
And once you get a municipality on board, do you also need to get the utility on board and all the end customers on board? Or like once the municipality's on board, like they can kind of get the elements of the product that you need for the end customers and the utility in place?
Yeah, the only time I would ever need national utility directly involved is if I was planning on wheeling between different municipalities. So right now, the way that we operate is that inside of a municipality, we can actually enable and support trading between the different households. So there's actually like trading that happens inside of the municipality that doesn't happen externally. And then beyond that, there's some additional excess that is aggregated across all the different meters or all the different producers within the municipality. And we just use that to send over to the national grid. So we reduce the municipality's bill itself. So from that standpoint, the core business model doesn't really require engagement with national utility. But what we're seeing is that it's always important to build these relationships with governments because we're using government-owned wires, whether owned by municipality or owned by the national utility, to send electrons. So there are like tariff feed-ins and stuff like that we need to deal with. The other thing is that the big picture, the end game for us is a national wheeling trading system, one that's not dependent on municipalities kind of being gatekeepers, but us being the trader, and we're basically interacting directly with individual meters one-on-one to be able to do that. And so to be able to do that kind of wheeling, we do need to have right-of-way agreements, both with the municipalities where the people are living, and then the national grid for the actual transmission between the cities.
That makes sense. And what about the end customers? Do you need to do anything? Do you need to get their permission for anything or do anything to get them, the individual customers, on board? Or is it, once you get the municipality, you kind of have all their customers or access to all their customers to do what you need to do?
Yeah, once we have the municipality, we have access to all their customers. The only tricky part is really just them giving us permission to come in and upgrade the meters if we need to upgrade them to a smart meter. But again, the selling point is, hey, do you want to either, make $0 with some net metering scheme with the municipality or, Eskom, or do you want to be able to make money on trading? And that's usually, nobody says no to that.
Hi,
Gotcha.
Shingai.
Thanks.
I have a quick question before I have to drop, unfortunately, early. But I wanted to ask you about your background. Can you tell me a little bit about how you ended up doing this?
Yeah, sure. So as I mentioned before, I'm originally from Zimbabwe. Both my parents actually met in the United States. So I was born here in the States, as you can probably tell by the accent. But up until I was about 12, 13 years old, I would go back to Zimbabwe every year until about 2000, at which point the currency started to become destabilized. The consequences of a lot of the sort of political shenanigans started to really, the bill started to become due. And we started shifting our focus and attention to South Africa. And so that's where I became very familiar with the South African market, the dynamics of the energy market, et cetera. And when load shedding started to become a massive problem around 2021, really, I had a really good understanding of all the players, both from the business side as well as the political side to navigate. And so that made me feel really confident in being able to attack this problem. Now, from the standpoint of sort of industry expertise, my background is a data science background. It had been sort of general so not industry specific. I've gone from healthcare, e-commerce, supply chain logistics, whatever, working with companies like Google, working with AB InBevs, Walmarts, et cetera, sort of on consulting basis. Got really interested in the solar part from some family that had a lot of land that asked me, hey, have you looked into solar here? It's a lot cheaper. We can make money on that. Quick Google, worked for 2 years at a solar development startup here in San Francisco, learned about sort of the solar financing model, learned that greenfield solar is just not profitable in the United States without becoming a tax equity game, which is not interesting. That actually, funnily enough, when people talk about risk in Africa, I think that it is far more risky to be a solar developer in the United States than it is to be a solar developer in Africa. From a president can write something on paper and destroy your business model overnight, which has literally happened to solar developers in the United States. So I think for all those reasons, I felt that it just made much more sense to develop in Africa. And furthermore, a lot of people come at solar from a clean energy, climate tech perspective. From an African perspective, I just say that I think it's premature to force Africans who contribute 3 to 5% max of climate emissions, of global emissions, to then switch their entire energy basis to clean energy, when the reality is that you have, a third of the continent burning trash for heat. It's almost insulting, in fact, to sort of make any sort of climate impositions. So my take on clean energy is more that solar is very cheap to install. It's also, from a economic perspective, very democratized in terms of people's ability to generate income from generating power, right? Coal, hydro, whatever, you need tons of capex. It's not accessible to the average person, but the average person can put an 8 kV or 8 kW system on their roof, or 12 kW system on their roof, and make a few $100 a day for themselves, a few $100 USD in South Africa. Like, that's life-changing for a lot of people in a lot of communities. So this is really an economic development play. And that's kind of how I see this. And that's, the tagline you saw in the very beginning. That's really what sums up my mindset and approach to this whole thing.
Thank you so much. I appreciate that.
Mm-hmm.
I want to be mindful of everyone's time, so I'm going to wrap up here. I will send out an email afterward with everyone's contact information so you guys can continue the conversation. I also want to give out a shout out for the next Founder Funder Mixer that Forward VC is organizing, and that one's going to be April 29th. It's free to attend for funders and funders. And I know that many of the founders on this call are curious about what it's like to be a funder. What kind of stage are you looking at? There are questions that haven't been able to get asked. So that's another opportunity to stay in touch afterward. But that's it for today. Thank you guys for attending.
Thanks, Echo.
Thanks, everyone.
Thanks, everyone.